Let's bring in Tom White, a senior options contributor and co-host of Fast Market, to help set up the action today. All right, Tom, so let's talk about these records. It's funny, the focus is on the job market today, but yesterday we got an ADP jobs report that came in much weaker than expected. Initially, that threw some cold water on markets because it was a loss of 33,000 jobs. But it was like, forget about all that when we heard the post on True Social about a deal with Vietnam. So with the markets at fresh highs, so much optimism is really just baked in. What's the catalyst today? Is it all about the jobs report?
Yeah, it is going to be all about the jobs report. And it's not only non-farm payrolls, it's jobless claims also. This is the big part of the Fed's mandate and why they haven't been cutting rates at all at this point, because it seems like inflation's under control. But this is that market. You kind of described it here, Diane, with the fact that, hey, it was a worse than expected ADP number, right? Negative for the first time since May of 2023. But at the same time, you have the Vietnam news that comes out. So it's like the market is climbing this wall of worry, but at the same time, it's pushing aside anything that's bad and kind of grasping a hold of anything that's probably positive at this point. Why are we seeing, more momentum to the upside here today, even though we're just slightly in the green, is probably because this tax bill is probably going to get passed today before that July 4th deadline. We've got the minority leader, Hakeem Jeffries, right now just kind of rambling on for the last 2 or 3 hours. If that gets passed, is that another catalyst to the upside? Will that overshoot maybe a weaker than expected jobs data, right? We saw that ADP come in light. Now, they're not totally correlated. We all know that. But if we do see continued maybe breaks in the jobs market, the unemployment rate's supposed to bump up to 4.3%. If we come in below 100,000 on this non-farm payrolls report, does that also provide some good news for markets, right? It's bad news. Maybe tech stocks take a hit. Maybe you rotate into more underperforming names. But at the same time, it almost gives the Fed that go-ahead for a cut in July. And what do markets like? They like rate cuts. So a bad number might be good for the markets. A good number might be bad for the markets, with some of those people thinking that we might get a cut in July. Maybe that's part of the optimism here.
Okay, yeah, so maybe that is part of the optimism here. When you think about that jobs report, it's been, it's not necessarily that ADP is seen as a signal nowadays so much as how it used to be in terms of the jobs report. So do you feel like the market's kind of like, well, it doesn't matter because they tend to diverge anyway?
Yeah, I think so. But I think if you start taking a look at the jobless claims, I think that's going to be one of the key things, right? We get that on a weekly basis. That's maybe a better reflection of what's going on out there. The continuing claims, 1.97 million last week, those continue to rise. That might be something that the Fed's going to focus in on a little bit more. But I think until you get that unemployment rate up to maybe 4.4, 4.5%, I think that's really going to raise the red flags and some of the alarms for the Fed. Now, we've seen some companies just yesterday, I believe Microsoft said globally they're going to cut about 4% of their workforce. Yeah, there's not really cracks because firms don't want to get rid of talent that they have, because they saw during the pandemic re-engaging talent when they need it is more difficult than actually, maybe cutting jobs at this point. But yeah, if you look at it, the Fed's kind of nervous about inflation ramping up here a little bit. But I think the crosshairs of this market and what they're going to do as far as their actions goes totally relies on the jobs market, because you know what? They lowered GDP expectations from 1.7 to 1.4% in 2025. If the jobs market remains robust, the consumer has a job, they're going to go out there and spend. That's going to support the economy. Maybe we're going to get some outsized numbers to the upside for GDP moving forward. But then again, at the same time, if this tax bill goes through, maybe that's conducive to businesses and the economy doing better also. So I think you just got to focus on the jobs number today. I think that's going to be key. But with one caveat here, we're getting a little bit stretched on valuation. Forward PE on the S&P 500 near that 22 level. That's that's overblown at this point. And then you start looking at the levels on a technical basis for the S&P 500. We're over in overbought territory, with markets at all-time highs. But the optimism's still out there, and the bears have been beaten down on this rally, and it's not a really loved rally at this point either, Diane.
Yeah, you make a good point. And then, we've been continuing to watch weakness in the dollar, but it feels like in terms of how overall market perception is, it's not seen as danger zone, even though we've been sitting at 3-year lows roughly on the dollar. Let me ask you, I want to go back to the points you made about the tax and spending bill. It does look like it's going to make its way. They essentially pulled this all-nighter in the House, but the sticking point seems to be the price tag, right? And how much it would add to the deficit. And now the Senate version includes that debt ceiling increase of $5 trillion. That's more than what the House had approved before. Do you think that's a hurdle that they overcome and kind of move past? This gets to the president by July 4th.
Yeah, everybody likes to go on vacation, Diane, and that's what I think they're all thinking about. And maybe they shouldn't be, but at the same time, it most likely will get through, if not today, sometime early next week. I think one of the key things is, you mentioned, yields at this point, and what this is going to do when the debt ceiling gets hiked up. Is that going to cause some volatility in the bond market? Because I think that's one of the things. We've seen a stabilization in yields at this point, right? And that's actually lent some support to the equity market at this point. If we get a little more added volatility in the bond market and yields, that's going to maybe cause some consternation, some headwinds for equities at this point. But at this point, you have to wait and see. Will we, if it's a bad number, will we see yields start to sell off a little bit with the expectations that we're going to get that rate cut in July? But those are things you have to watch in this market. But I think one of the key things, because the bond market is so much bigger than the stock market, watch for some added volatility in the Treasury market.
And Tom, really quickly, are you expecting, just a low volume day, given that it's a holiday shortened day? We've got the 4th in front of us. People are just, kind of phoning it in.
Yeah, we should see some lighter volumes, especially, right after the open. But at the same time, that also provides some opportunities for traders, right? If there's not deep liquidity in the markets at this point, because a lot of people will take off right after the open, maybe, that might cause some additional volatility and some choppy moves at this point. But all eyes on that jobs data and expectations for the unemployment rate to rise to 4.3%. If that happens and we get a worse than expected number, who knows? We could probably rally on bad number. And like I said before.
Yes, lately it's been like, forget about all that. Bad is good, good is good. All right, Tom, we'll leave our conversation there. That's Tom White, co-host of Fast Market. Thank you, Tom.